Hi everyone, welcome back. Today we are going to break down NXP Semiconductors' first quarter 2026 results. Plenty to unpack here. A quarter where the recovery story finally starts to look real, where Industrial and IoT comes back from the dead with 24% year-over-year growth, and where a one-time gain on a divestiture pumps GAAP earnings up to $4.43 a share. Let's dig in. Before we look at a single segment table, here's the number that should make you sit up. Industrial and IoT, the segment everyone wrote off through the entire 2025 inventory correction, is up 24% year-over-year. Not auto, not mobile, industrial, the segment that was supposed to be the slowest one to recover. That is our story for today.
Now zoom out for a second. Yes, revenue is down 5% quarter-over-quarter. That's normal Q1 seasonality. That's not the story. The story is the green trajectory, 5 quarters in a row of year-over-year improvement, and we just printed $3.18 billion, up 12% versus a year ago. And as we'll see later, management is guiding for plus 18% year-over-year at the midpoint for Q2, so the ramp is supposed to keep going.
Quick context for anyone new to the name. 2 minutes, then back to the numbers. NXP is a Dutch chip company headquartered in Eindhoven, ticker NXPI. $12.3 billion of revenue last year, more than 25,000 customers, and crucially, no single 10% customer. That diversity matters when we get to the bear case later. Rafael Sotomayor took over as CEO at the end of 2025, but he was already the operating chief, so don't read this as a pivot. Look at the wedges. Almost 6/10 of NXP is automotive. Radar, electrification, software-defined vehicle processors, the things that turn a car into a computer on wheels. Another 19% is industrial and IoT, factory automation, smart buildings, healthcare. That's the strategic 77%. Mobile and comm infra are the long tail. So when you hear NXP, think auto and industrial pure play, not a generalist chip company. Geographically, the company is balanced. Americas, EMEA, and Asia-Pacific each chip in roughly a quarter of revenue, with Greater China specifically running about 17%. So no one region can sink the quarter on its own, which is part of why Q1 held up the way it did despite all the trade noise. For scale, NXP is about a $56 billion market cap company, trades at roughly 22 times forward earnings. That's a discount to most large-cap peers. They're playing in the auto and industrial slice of a chip market that McKinsey thinks gets to $1.6 trillion by 2030. Not NVIDIA territory, but the discount tells you the market is skeptical that they'll capture it. The competitive set is essentially Infineon, STMicro, Texas Instruments, Microchip, and Renesas. The horizontal axis is recent growth, vertical is auto and industrial focus. NXP and Infineon are the closest pure plays. TI is much bigger but more diversified. STMicro and Microchip are still digging out of the cycle. The question for the quarter is whether NXP's growth pulls it cleanly into that upper right quadrant. And here's what the long-term plan looks like from their 2024 Investor Day. Step up from mid-single-digit revenue growth, push gross margin above 60, operating margin into the 34 to 40 range, and the moonshot, double earnings per share by 2030. We'll come back to whether Q1 makes that look more or less plausible. Okay, enough background. Let's hit the headline numbers. 6 tiles. Top row left to right, revenue $3.18 billion, up 12. Non-GAAP gross margin 57.1, up a full point year-over-year. Operating margin 33.1, up over a point. Bottom row, non-GAAP EPS 3.05, up 16. Free cash flow $714 million. That's a 22.4% cash margin. And then look at the bottom right, GAAP EPS 443, up 130% year-over-year. That asterisk is doing a lot of work. We'll come back to it. Pause on this for a second because you'll see $4.43 in every headline tomorrow. It is technically correct, but the real operational number is the non-GAAP 305. The $1.38 GAAP is almost entirely a single divestiture gain we'll dig into in a few slides. So if you only remember one thing, the underlying business earned about $3 a share, not $4.50. The margin picture is the second good news. Both lines have been climbing for a year. Gross margin sat above 57 for 3 quarters running. Op margin took a small step back from Q4's 34.6 down to 33.1. That's mix, less revenue absorption, totally explainable. And the Q2 guide says we go higher again, so the trajectory is intact.
Now let's open the hood on revenue.
Stacked bars by segment over the last 5 quarters. Auto in blue is still the bulk, about 56% of the bar. The green industrial slab has visibly thickened. Commercial infra in purple is surprisingly steady. Mobile dipped quarter over quarter, and that's the one mix issue we'll discuss next. This is the chart that flips your assumptions. Look at the order. Industrial and IoT plus 24, biggest growth. Com infra plus 21. Mobile plus 16, and the segment that's almost 6/10 of the company, auto, is plus 6. The largest engine is the slowest one. That tells you the recovery is not being led by where you expected it. Zoom in. Industrial and IoT did $628 million in the quarter. That is $120 million more than the same quarter last year out of a single segment. That alone added 4 percentage points to the total company growth rate, and the run rate now would put 2026 north of $2.5 billion versus 23 for all of 2025. Channel inventory is at 11 weeks, which is the level the CFO has been calling normalized, so this isn't a one-quarter pop, this is the cycle turning. Auto did 1,782 plus 6 year over year. The interesting detail is how that 6% breaks down. Light vehicle production globally is barely growing, call it 2%, so almost all of NXP's auto growth is content per car. The growth driver pieces, the S32 software-defined vehicle processors, radar, and electrification, are running at 15 to 25% CAGR. The legacy core microcontroller business is only growing about 3. That's exactly the mix shift the strategy depends on. Quick stop on the smaller two. Mobile dropped 19% quarter over quarter. That's the smartphone seasonality. Every chip maker sees it. Year over year, still up 16. Com infra is the quiet one, only $380 million in revenue, but plus 14 quarter over quarter and plus 21 year over year. So 2 segments that combined are only a quarter of the company, but they're contributing 8 points to the headline growth rate. One last way to anchor what just happened in industrial. 24% sounds abstract. $120 million added in a single quarter, in a single segment. That's the equivalent of adding a small chip company every 3 months. That is the engine that turned the year-over-year line green. Now let's flip to the spending side and the cash story. Here's the income statement as a flow. 3,181 of revenue, take out cost of revenue, you get gross profit of 1,788. R&D, SG&A, amortization, all run rate costs, and then look at the green bar on the right, plus 621 of other income. That is the MEMS divestiture gain. Without it, GAAP operating income would be $884 million. With it, $1,505. Whenever you see GAAP operating margin jump from 25 to 47% in one quarter, there's always a story behind it. Here it is on its own slide. February 2nd, NXP closed the divestiture of the MEMS sensors business. $878 million in cash, $627 million booked as a one-time gain in other income. That single line is what creates almost the entire delta between GAAP and non-GAAP earnings this quarter. Subtract it out and the underlying business looks great, just not historically great. Slope chart, Q1 25 versus Q1 26. R&D up 7%. They are spending into the SDV and radar opportunity. That's the strategy. SG&A virtually flat at plus 1%. That's where the operating leverage is coming from. Cost of revenue grew 9% against revenue up 12, which is exactly how gross margin expanded a full point. The pattern is clean. Invest in R&D, hold SG&A, get leverage. This is the slide where I want to stop the GAAP versus non-GAAP sideshow. Cash doesn't lie. Free cash flow, $714 million, 22.4% of revenue. A year ago, that number was 15%. So in 12 months, they added 7 percentage points of cash conversion. CapEx was only $79 million. They're staying disciplined on plant. The MEMS sale shows up in investing cash flow, not here, so this number is genuinely operational. And on a trailing 12-month basis, FCF is now approaching $2.7 billion. $250 million in dividends, $102 million in buybacks, and $500 million used to fully retire a tranche of 5.35% senior notes that was maturing in March. So roughly $1 billion went out the door in capital return and deleveraging combined, and that was funded by a combination of free cash flow and the MEMS proceeds. The capital return policy hasn't changed. 100% of excess FCF flows back over time. Quick balance sheet check. Net leverage 1.7 times trailing EBITDA against a self-imposed ceiling of 2. $3.7 billion in cash even after retiring the $500 million in notes. Interest coverage is 14.5 times. The only flag, yellow not red, is the blended cost of debt at 3.88%, but the maturity profile is well laddered out to 2051. No balance sheet stress here. Okay, let's look forward. This is the most important slide for the next 3-month thesis. At the Q2 midpoint, revenue jumps to $345 billion, plus 18% year-over-year, accelerating from the plus 12 we just printed. Gross margin steps up to 58%, operating margin to 34.7%, which would actually beat Q4's record. And EPS jumps to $3.50. If the quarter prints anywhere near the high end, this becomes the cleanest growth quarter NXP has had since 2022. The product news was unusually thick this quarter. The S32N7 super integration processor for software-defined vehicles, a collaboration with GE Healthcare on Edge AI, that's the medical device side of industrial. The EIQ Agentic AI framework, yes, NXP is now in the Agentic AI conversation. The MEMS divestiture mid-quarter, a new IMX93W applications processor, and maybe the most interesting one, a robotics collaboration with NVIDIA announced on March 16th. The pipeline is broad and it's biased toward physical AI. The medium-term picture from the 2024 Analyst Day. Auto and industrial both growing 8 to 12% CAGR through 2027, taking total company revenue from $12.3 to about $16 billion. Mobile and comm infra basically flat, so the strategy is unchanged. Squeeze single-digit growth out of the long tail, double-digit growth out of the strategic pair.
The other long-term lever is manufacturing. NXP is consolidating to its own fabs and JVs. They call it hybrid manufacturing. Front-end internal sourcing goes from 38% today to 80% by 2030. Wafer volume goes up 50%. That mix shift is what gets them above 60% gross margin in the model. So the margin expansion isn't just mix, it's a manufacturing footprint decision they made years ago that's now paying off.
The whole multi-year pitch sits on this number, doubling non-GAAP earnings per share by 2030. From today's run rate, that's roughly $25+ a share. To get there, NXP needs revenue to grow mid-single digit, gross margin past 60, and the buyback to keep shrinking the share count. Q1 advanced all three. Whether the next 16 quarters do too, that's the bet.
Last section. Let's score the quarter honestly. Honest scorecard. The bull case is loaded. Revenue back to plus 12. The Q2 guide accelerates to plus 18. Industrial up 24. Margins expanding. Cash returning to shareholders. There's a real bear case too. Auto, which is 58% of revenue, only grew 6%. That's not enough to drive the long-term ambition. The GAAP EPS headline overstates by $1.38. Operating margin actually stepped down from Q4. And China at 17% is exposed to whatever the next round of tariff escalation looks like. The deck tilts bull, but the bear concerns are real. 6 things to watch. Green, Q2 execution against the guide and whether industrial sustains the run rate. Yellow, whether auto re-accelerates and whether gross margin actually crosses 58. Red, China exposure. There's nothing NXP can do about that, but it will move the stock more than anything else on this list. And neutral, just keep CapEx disciplined. That's the watch list for the next 2 prints.
That's where I land. The recovery in NXP's numbers is real on every metric that matters: revenue, margin, cash flow, segment mix. But one quarter of plus 12 doesn't make a multi-year compounder. The Q2 guide says the company believes the next 3 months should be better than the 3 we just looked at. If that lands at the high end of the range, this becomes the inflection. If it lands at the low end, this was a bounce. That is the question that hasn't been answered yet, and the next print will tell us. That's it for today. Don't forget to subscribe. See you next quarter.